Okay, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Very good morning to all the students. Today, we are going for the chapter 8 on the TAKAFUL underwriting, the basics, surpluses, and RETAKAFUL. So, the objective of the learning, we have it down there. Yeah, we'll bring you through all the objective. Okay, here we have another new words that you're going to learn. RETAKAFUL. So what is the takaful and what is retakaful? Contribution of the policyholder are not the exchange condition in price as in the conventional insurance. So in the event of the deficit or surplus arising of takaful fund, appropriate treatment of the fund should be reflected in the nature of contribution. We'll explain that later. Yeah? In this chapter, we will consider the treatment of deficit and risk fund, underwriting surpluses, and the practice of retakaful. So in a dual system, the issue of insurance by takaful operator is also addressed. So basically this topic will discuss more in detail of the function of the takaful operator. So what happen if the claims by the policyholder exceed the funds or exceed the free premium that they have been collected from the policyholder. Yeah? So we go to the two types, one is family, one is general. So takaful being a mutual character does not impose any financial obligation on the takaful operator to pay the entire claims outstanding if the takaful or risk fund is in deficit. What I mean here, if there's, for example, we take a good example in Malaysia lah. The Malaysian airline shot down in Ukraine. So there are hundreds of people died. So all of them will claim the insurance. You just imagine. So, and this kind of insurance is very big in number because it's accident, flight accident. So the amount become big, maybe millions, hundreds of millions. Yeah. So if the takaful operator from the premium cannot pay, so what happened? These are the things that you're going to learn. For example, total amount of collected by takaful. For example, just now in the Mars airline was shut down. The premium that they collect is maybe 100 million ringgit. But because all of them died at one go, the claim come to maybe 300 million ringgit. So how the takaful operator to pay the claim? Because they only collected 100 million ringgit. These are the things that you're going to learn and how the system work lah. Third, under the very concept of takaful, it is the fund that is common pool of donation that will have an obligation to pay to the claim. So their concept is that they collect the premium for you, and if any one of you got accident, they will use that money to pay. I give you a good example back. Last time I said, if 5 of you going for a picnic, you collect 100 ringgit each. If one of you got injured and need the 500 ringgit, you will get the money from the 500 ringgit. That's how the takaful company or takaful operator work. The same concept. Yeah. So in this case, just now, if the aeroplane crash, shot down, the claim from the policy holder is 100, more than the premium they collect from the policy holder. So how are they going to solve it? So this is the meaning of mutual contribution and mutual indemnity. So how they doing to settle the problem of the concept of the mutual contribution, and then they're going to identify every one of them. But the money they collect is less than what they claim. So in case of Malaysia, there is a requirement by the takaful regulator for the takaful operator to pay the outstanding claim using the shareholders fund. So in the previous chapter, we already mentioned that for the takaful operator or the takaful company to set up, they must have a minimum paid up capital. For example, the government says you must have a paid up capital of 10 million ringgit. Yeah. So then only the government will issue them the license. So in the case that they collect the premium for 20 million ringgit, and suddenly some big case accident like the Malaysia Airline, the claim is 25 million ringgit. So the premium they collect from all of you, policy order is like 20 million ringgit. So there is a shortfall of 5 million ringgit. So the government said, well, you said the company last time you have a paid up of 10 million ringgit. You use your own paid up capital another 5 million ringgit to pay off the claim. So that's how they work. Yeah. You must just understand the basic logic. It's not that difficult to understand. So treatment of underwriting surpluses in TAKAFUL. So now, just now we're talking about deficit. So now we're talking about surplus. So surplus in TAKAFUL result from the difference between the residual from the total premium plus investment, return, net claims, expenses, and relevant provision. So such person answer 3 to part of TAKAFUL. If years where claims are low and surplus will grow, in worst case, the surplus may not be sufficient for insurance company. It goes without saying the insurer must properly. Okay, in summarize, you can read that one. In summarize, what happen if the surplus situation? Just now deposit, now surplus situation. So they've been collecting premium from all the policy holders every year. For the last 10 years, now they collect about 100 million already. Yeah. For the last 10 years, the claim was small. There's no big catastrophe like the Malaysian airline shut down or anything. So for the last 10 years, they've been collecting premium 100 million plus their own capital 10 million. So they have 110 million in their account. So now within that 10 years, so the claim may be 20, 30 million. So they have surplus of 70 million plus their own capital 10 million. So they got 80 million. So what they're going to use for this 80 million after they deduct yearly dividends or profit distribution, they still have maybe another 40, 50 million. Yeah. So here is the situation where they have the surplus money. It goes without saying that the insurer must properly manage the underwriting risk in terms of selection of policyholders and the inherent risk, premium, and indemnity correction, and risk to be transferred to reinsurance company. In the worst case, surplus may not be sufficient for the insurance company to meet all claims. Okay, there's two situations here in this note. One is that you have surplus. The other one, just now, you don't have the surplus. So, first part, you have surplus. You need to think what to use with the money to invest. Second part, there is no surplus. For example, the case of accident just now, the claim is they collect the premium 100 million, but the claim now is 300 million. So how are they going to solve the problem? So that's where we have to say that they have to do the next step to cover their risk to cover the 300 million to pay off the thing. So we will learn from here. That's where we come to the RETAKAFUL situation. So in Islamic insurance or takaful, the treatment of the surplus is critical, and not only from a commercial perspective, as highlighted above, but also more importantly from a syariah perspective. So first situation, when they have the surplus, they need to invest the money. They need to make more profit so that they can distribute at the end of the year to the policyholders, the profits. The risk has been transferred to the insurer, and therefore any surplus from the premium will be treated as profit to this insurer. Essentially, this feature commonly associated with general insurance industry vis-a-vis life insurance. This approach does not suit takaful, which, unlike commercial insurance, is based on mutually or contribution indemnity. It can be inferred that this concept that all premiums and thereafter and surplus should belong to the participant. So whatever the surplus, it doesn't go to the takaful company. It all belongs to the policy holder. We learned that in the previous chapter. Shareholders of the takaful company do not share on this surplus because it belongs to a participant collectively as defined by the takaful contract. Accordingly, several fatwas and Sharia ruling have been issued by many takaful companies confirming that the participants have the exclusive right on the underwriting surplus. So what I mean here, whatever the surplus of the takaful does not goes to the takaful company or the owner of the company. So the company must be owned by, let's say the takaful is owned by me, so it doesn't goes to me because I'm the owner of the company. Or the takaful operator belong to a bank, so it doesn't go to the bank. So all the surplus will go back to the policy holder. Not in the conventional situation. Conventional situation, after conventional insurance, after all has been deducted, the surplus will be benefit will go to the profit to the owner of the takaful or the shareholder of the takaful. Yeah, you must be very clear. One is the shareholder of the takaful, the owner of the takaful operator. The other one, we, the public, which is the policy holder that will pay the premium. Please understand these two distinct. If not, what I mentioned here, you won't be explained. You confuse yourself. Yeah. So the takaful only may invent the takaful surplus on behalf of the participant. If there is in any express in this effect, the takaful policy, such investment aspect. So basically, when you buy the policy, they will also have some mudarabah contract that you have to sign with them. That they will allow the extra money for investment purposes on to get profit return to be give to you. So this is signed in the first situation. One you buy as a policy holder to cover you. The other one you sign as a contract mudarabah to allow the takaful operator to invest the extra money surplus that they have. In anticipating of returns, profits at the end of the year, they can give back to the distribute back to the policy holder. So sharing the surplus. So some takaful have adopted another mechanism with regard to the treatment of surpluses. They argue that the surplus sharing is kind of incentive fee to render them more prudent in their underwriting and selection of participants. They contend that the fees for managing takaful can be levied on two levels, namely on the inception as well as the end of the operation in the norm or the share of surplus. Both fees can be based on certain percentage. Yeah? So the fees paid to the takaful operator at the end result in the sharing of surplus between the participant and the operator. So let me explain here. We've been saying that all the surplus must go to the policy holders back after deducting the expenses by the takaful operator. But some takaful operator have another concept. They are copying a little bit like the conventional insurances, that they should not only pay the fees to operate the takaful, they also want a part of the profit for the takaful operator as an incentive for them to work harder to make more money for the policy holder. So that can be accepted if the policy holder and the takaful operator agreed. For example, like in the mudarabah contract. So in this case, say that whatever profit takaful operator will take 30%, the balance 70% only will distribute to the policy holder. This also accepted in the Sharia compliant law if both parties agree. But in principle, the Sharia law does not allow them to take any profit other than the fees or services that they take. But again, I said it depends on both parties. If this takaful operator suggests that one and the policy holder agreed, you can still proceed. Yeah, which then you can choose. One takaful operator does not charge this profit sharing. The other one have profit sharing. So you can choose whichever you want. There's always pros and cons. Those who are not having the profit sharing, maybe they work hard because they don't see any money can get to the takaful operator. They just invest your money for minimum return maybe because they are not getting any profit. But if there's a profit for them, they may be even work harder. Work harder. This is a normal human being instinct. You give them incentive, they work harder. So it's allowable in the takaful industry, Islamic way, if both parties agree to proceed another mode of profit sharing. Okay. So they were talking about surplus. So now we're talking about deficit. So this way they come the policy of reinsurance, or they call it here RETAKAFUL. So when there's a deficit, so reinsurance means by which conventional insurance companies can protect themselves against the risk of loss by transferring some of all of the insured risk to other insurance company known as reinsurance company. Individuals and corporations obtain insurance policy to provide protection for various risks. Yeah. So it's good example just now the Malaysian airline shut down, or in the case of big what do you call it, hurricane or earthquake. Yeah. So there's big earthquake in Kuala Lumpur. Half of Kuala Lumpur building destroyed. So the insurance policy holder for this in Kuala Lumpur will start claiming their money. So the Takaful company, let's say just now, they only collect 100 million, but the claim there is maybe 500 million by the policy holders. So this way we have the policy of reinsurance, or we call it RETAKAFUL or risk transfer. So in summary, what will happen is that there are bigger insurance company. Let's say now my Takaful company, I own a Takaful company, or one bank, Maybank, own a Takaful company, the paid capital is only 10 million ringgit. But there's another big insurance company, the paid capital is 500 million ringgit. 500 million ringgit. So they are big Takaful operator because their paid capital is 500 million ringgit, or even 1 billion ringgit. So I, as a small Takaful operator with only 5 million ringgit, I can reinsure my risk to this big Takaful operator. Okay, what it means? Simple. Yeah? Simple is that my paid up is 5 million. I collect maybe premium 100 million. But my risk from this policy holder, for I can foresee if the big catastrophe like the floods or earthquake, the claim maybe come to 300 million. I predict from my policy holder that they already buy from me. So if this happen, where am I going to get the money to pay the 300 million? I am a Takaful operator. How am I going to pay the 300 million claim by the policy holder? My paid capital is only 10 million. If I collect 100 million and the claim by the policyholder at one time because of the earthquake 300 million, and my paid capital is only 10 million, I only can pay 110 million. Where am I to get another balance of the 300 million that they claim by the policyholder? So what the small Takaful operator did is that they will reinsure their risk to the big company. So the premium that you pay, the policy that we pay, the premium, let's say 10,000 premium. So they will reinsure the risk of the 10,000 to another bigger company by paying them premium from your money. You pay the Takaful operator 10,000 premium, they will reinsure the risk to a bigger company. They will use that 10,000, maybe 5,000 to pay the premium to the other bigger company for the purpose of sharing the risk. In case there's a big catastrophe, big amount need to be claimed, then like example I gave just now, if the 300 million claim, I have only got 100 million policy premium plus 10 million paid up, is already 110 million. So I need the balance. 300 minus 110, I need another how much is that? 190 million to cover the claim at one go. So the big insurance company, which just now reinsurance or we RETAKAFUL, they, because their paid capital is 500 million, they're big. So they will come to cover the balance of 190 million. Yeah. So that is the story of this reinsurance of RETAKAFUL. Yeah. In summary. Yeah. So what this means? The risk transfer. You transfer. I am a small operator. I transfer my risk to a bigger Takaful company, bigger insurance company, but they also will ask for some premium lah for them to take your risk. That's between the smaller Takaful and the bigger Takaful company to negotiate lah. Yeah. Because you as a policy holder You're not bothered to know anything. You already buy the insurance from the small takaful company. It's the jobs of the small takaful company to cover their risk, to reinsure your policy to a bigger takaful company. So they call it risk transfer lah. So the main reason for insurance is to allow the primary insurance, which the small takaful company, uh, known as the seeding company, seeding company or a small company, to assume the risk greater than its size would otherwise allow, and to protect the cedant against catastrophe losses. That's how I explain just now. They're a small company, they cannot cover at one go big catastrophe, so they get a bigger company to support them. So reinsurance allows the insurance company to offer larger limit of protection to a policyholder and its own capital will otherwise allow. So in case let's say if my paid up capital is 10 million, I collect the premium 100 million. But I calculate all the policyholder is any risk is maybe 80 million. I don't need to reinsurance or retakaful your policy that we buy from them, because they calculate the risk is only, if anything happen catastrophe is only 80 million. So they have enough money. If they have enough money to cover, they don't reinsurance or retakaful the risk. Okay. So income smoothing, reinsurance can help. Reinsurance here is retakaful lah. Can help to make the insurance company result more consistent by absorbing larger losses and reducing the amount of capital needed to provide the coverage. I give you an example just now. This is what actually it meant lah. So without such a reinsurance, the company profit for a year in which large claims were made against, for example, just now, sudden earthquake, would not be consistent with the consecutive years. As for the capital, the insurance company would need to maintain the same level of liability and also the returns that they have to give. So if they don't reinsurance the risk, so in any 1 year there's a big catastrophe, then the whole that year they cannot pay any dividends or benefit to the policyholder. So there's a risk for the policyholder. But if they already retakaful, so if the claim is big, so half of them will be taken over by the other bigger insurance company. They still can maintain to give the benefit to the policyholder as what they be given in the past years. So that is what they're trying to give the meaning. So there's two benefit. One, the risk transfer, so that they can still cover the payment for the claim. Second, they still maintain and give the average profits or return they can give to the policyholder every year. So that is very important of this reinsurance or retakaful policy. So okay, let's see what here. Surplus reserve. An insurance company surplus is equal to asset as liabilities, which is roughly the same as shareholder equity in the balance sheet of a non-insurance company. That's simple. A surplus means after minus everything, you got extra money. So what you want to do? Reinsurance can improve the insurance company balance sheet by reducing the amount of liabilities and thereby increasing the surplus. So normally they have to submit their annual account to the government. So if they said they have to put a calculation down there. If they collect premium 100 million, the government said from your 100 million, how much you think you will, the risk you going to cover. If the cover is 300 million, then the regulator or the government who issue the license will say, how are you going to cover 300 million? You collect premium 100 million, your paid up is 10 million. Something happened, the claim, as you said, yeah, is going to be 300 million. How are you going to pay? So that's why they have to put in the balance sheet, okay, we already reinsurance it, we retakaful it to a bigger company. This bigger company will come and assist us if any big claims come at one go. So this is another benefit of the retakaful or reinsurance, because it can answer to the regulatory will ask by the government how they going to solve the problem if they have this kind of situation. Yeah. Because the government is not going to come and help. There's no way, because this is all under private initiative. So arbitrage, the insurance company may be motivated by arbitrage in purchasing reinsurance coverage at a lower rate then the amount it charges the insured of the underlying risk. So normally the reinsurance company, the big company, will also not charge a very high premium because they are very big, so they have a lot of premium they collect. So normally the small takaful company, the reinsurance premium they pay, it won't that very big, so it's quite reasonable. So this policy is working very well in the insurance industry, whether they are conventional or even the takaful insurance. Yeah? Insurance arbitrage is a financial transaction that produces immediate profit with a lower risk involved. So they pay small risk, but they're going to get large profit covered by the bigger insurance company in case of any catastrophe. So the gain in arbitrage is made through the advantage taken on the different pricing models and tax discrepancy that exist in the market. Well, basically in the RETAKAFUL insurance, there are also benefits, incentives that government gave, so that the small takaful can benefit and pay small premium to the bigger takaful company to cover their risk. So that's what we are explaining here. If they pay so big premium to the big takaful company, then it's not going to help the small takaful company. So the government give some incentive to big takaful company or reinsurance company, big takaful insurance company or reinsurance company, a lot of incentives so that they can help the small takaful company to survive in case of big claims. The takaful industry is relatively young, and many of the companies face dilemma in relation to the insurance. So as I mentioned just now, as our takaful insurance is quite new, 1983, after the first Islamic bank, then they have the insurance company, the Government Act 1983. So because of that, they are not very strong financially. So that's why the reinsurance takaful become a big help to help those small takaful company which is just started in operation. They have to take many years to collect millions of premium. You can't collect 100 millions of premium within a year or two. Yeah? So as many takaful companies, they are still small in terms of capital. The need of reinsurance service is relevant in order to transfer the risk to another party. That's what I've been telling just now, which has a bigger capital to cover the future claim. So at present, most retailer company are so small. No, the most retailer company are also small. Even in Malaysia, the retailer company is also small, not as compared to the big retailer company in overseas. Here, maybe I said the takaful company paid up capital 10 million, but retailer company here maybe 100 million. But RETAKAFUL or reinsurance company in America, oh, their paid capital is billions. So that's what we're trying to say. Because in the Islamic insurance, because they just started, because even RETAKAFUL company, their paid capital is not big compared to RETAKAFUL or reinsurance company in the conventional. For example, AIA, American International Insurance. Oh, their paid capital is billion US dollar. Yeah? So that's what we're trying to say. But nevertheless, we have to start something small, and then we grow lah the Islamic insurance, because those conventional also, they have already for 100 years, yeah, not 1 or 2 years. We only talking about 10, 20 years. Conventional insurance will be there for maybe 200, 300 years. Yeah, so that's why their capital is much bigger. The issue that arises is whether a takaful company can reinsure or transfer a risk to another conventional insurance company. So now whether the Islamic takaful can reinsure or retakaful to a conventional insurance company. So this is also now under a lot of discussion, because whether the retakaful insurance company or conventional reinsurance company, whether they Sharia compliant or not. If they are Sharia compliant, yes, it's allowable. But the activities of this reinsurance conventional is not Sharia compliant, then the takaful or the takaful insurance Islamic cannot use the conventional reinsurance to retakaful their risk. So the most likely answer is that the incumbent upon the takaful company to reinsure a risk to retakaful that conduct a retakaful operation according to the Sharia compliance. So they have to look around lah. If the conventional reinsurance, some of them may have running operation with the Sharia compliant principle, with a minimum non-compliant, then they can reinsurance their takaful to the conventional insurance company. So as we know, everything is still developing. They are still coming with policies and ways of solving the problem. So it's not settled, everything is settled today. But we learn, we teach you what is happening today. But in future, they may change. They may change the policy and rules that you, as a student, that's why you must learn now all the basic things. Then in future, with any changes, you will be easy to understand what is happening. If you don't understand what's happening today, in future what they talk about retakaful insurance, you also don't understand why they're changing the policy. So this is very important. Whatever we have today, we learn, we teach you. We use an example like the COVID, what do you call it? The COVID injection, vaccine. The vaccine today, some people know good, some people say good. Very simple. Whatever you have vaccine today is the best already. Yes, in future, 5 years time, there are better vaccine because people develop more. People come and with a new version of a better vaccine. But it's not for you. Maybe that's for your children, for your grandchildren maybe. Because my age, 65 years, I'm dead already by 10 years or 20 years time. So even the new vaccine come, I'm not going to use it. But what today the vaccine is already good for us. So we just take it. We don't say that there are going to be future good vaccines. For sure. Those vaccines they use for the flu 30 years ago is different. Those vaccines they use for malaria sickness 30 years ago is different from the vaccine we use today for the flu or for any other diseases today. So same thing like here. The insurance or reinsurance, whatever happening today is what is the best. But this is where you need to learn. Tomorrow they could start changing new laws, new things. You understand what's happening. Yeah? Okay, the practice of using conventional reinsurance, companies reduce the takaful risk. I already mentioned that just now. Why they need the retakaful or reinsurance. Only retakaful comply with Sharia. We already said just now. In basic, they only can retakaful with Sharia compliant. Whether there is a retakaful insurance company or conventional company. If there's a Sharia compliant activity, they still can use the retakaful lead to the conventional reinsurance scheme. Okay. In takaful operation, participants are individual or corporation who seek to protect each other by joining scheme of mutual donation and mutual protection. The takaful activity is someone who manage the whole takaful activity for consideration, that is wakalah fees. So normally, as we know, we have to pay certain fees to the takaful operator for operating our money, the policy, and also to protect our risk and our investment. But as I said just now, there are some takaful company also asking to take a profit of the investment, which is allowable in the practice if both parties agree. Yeah? So Islam is not really a very rigid law that you cannot even move here and there. In Islamic law, there are basic principles, but there's always exceptional to the law, which can be done if both parties agree to a situation where it is manageable. For example, now the takaful want to have a profit. See, they say they take 30% of the investment profit and the policyholder takes 70%. That still may be allowable in the Sharia law. But it won't be allowed in the Sharia law if the takaful operator say, we take 70%, policyholder take 30%. Then will be allowed because it's underway is like our pricing. Yeah. So there are a lot of things need to learn further. If they allowed or don't allow, doesn't mean that they're allowed they can do what they can do. But this must be fair to the both party. In Islam, there always a fairness that they are looking for. Yeah. If there is a deficit in takaful risk fund, the shareholders of takaful will lend their money on an Islamic basis, which interest fee. The takaful has the right to reimburse the advance from the next subsequent year. Okay, this is very simple. Yes, now I said, if let's say the takaful operator collect 100 million premium, their paid capital is 20 million, but that year the claim is 110 million. So they have to use their own capital out of 10 million. Take out of 20 million, let's say the capital, and the premium is 100 million, and the claim that year for earthquake is 110 million. So from the premium, they can only pay 100 million. So they have to take from their own capital, the takaful operator, 10 million to pay for the shortfall. So it's allowable. But in future, when they collect back the premium, they can take back the 10 million that they pay in advance for the risk to cover back the money that they already advanced for the indemnity that people claim. Yeah? So that is what they mean. So as I said, it's always benefit for both parties, and fairness is what the Sharia law is looking into. Okay, in summary, conventional insurance is broadly categorized into life insurance, non-indemnity based lah. Life insurance is more for your personal lah, yeah. And general insurance indemnity based, let's say, for insurance to cover your house. If your house burn, and this is the insurance will cover. So we call it that one non-indemnity based lah, not personal. Yeah? So there are two types of insurance. Two, surpluses result from the difference between the residual from total premium plus investment return, net all the claims, expenses, and relevant provision and reserve. So surpluses, that is what the surpluses we're talking about. From that surpluses like just now, they're going to invest or they're going to share the profit. Third, the surplus reflect primarily the quality of underwriting and insurance companies in their risk underwriting process. Such surplus are necessary to part of a takaful. As I mentioned earlier, if the takaful operator only get a small piece from the investment, they may not do a good job. So what we call it, the quality of their job is not what expected. So, but if there is a chance that they also can make a certain portion profit from the investment return, then they can do even a better job. So maybe the quality of underwriting is much better. So that's why there's always pros and cons. There's an incentive there. If you can allow, both parties can allow them to make additional profit from the return, they may invest better or they may even do a better job. The quality of their investment is much better. That's what we're trying to say. That's why in the Sharia law, we allow. Not only they can get the fees, but they also can collect a small portion of profit if both parties agree. If that will help them to as an incentive to give a quality underwriting job for the policy holder, I mean for you all. Fourth, insufficient surplus might mean that the insurance company cannot meet all claims and deficit that will have to be met using shareholders' fund. Okay, so one is that, as I give the example, if you collect premium 100 million, you paid up 20 million, suddenly the earthquake, the claim of 110 million, so the takaful operator have to use their own fund, paid up capital that 20 million to advance 10 million first to settle the thing. But in future, they still can collect back the 10 million which they advance from the future premium they're going to collect from the policy holders, because the insurance company is not going to close. They're going to solve only the current problem, but they continue. They collect policy holder premium in future. They get millions more in future. So they will collect back whatever money they have advanced to solve the claims. Okay, lastly, the surplus belong to the participant in the takaful scheme and not the takaful company. Okay, the surplus belong to the participant, not goes to the company. Compare with the conventional, all surplus after minus everything, it goes to the company. That means goes to the company, it goes to benefit to the shareholder of the company. Here in Islam cannot, because it's more like, as I said, here it's like cooperative, kerjasama. You have to make together. You make money, you share the profit together. Whereas the concept of conventional insurance is not like cooperative. It's more commercial. Yeah? They do business, they want to make profit as much as possible. Whereas in the takaful, no. The minimum, you have to pay whatever fees, the operating fees they have to pay. Then the rest will share by the policy holders, the benefit. Unless, as I said just now, they have a contract that they also can take small portion from the profit. That is allowable in Islam, so that they can give a more quality job to do the investment. Maybe through that way, the takaful can make more money, and the policyholder can make more money also. Rather than they give you small fees, they don't do a good job, then you also got a small return. So it's a win-win situation, and depend on both party agreement and discussion for the benefits of the takaful operator, and also for the benefit of the policyholder. Yeah. So that's the end for our today chapter on this retakaful and risk, how they operate. Because if we don't teach you, you also may think, in case of, like case of the Malaysian airline, how they solve the problem to cover the claims. And for example, tsunami, billions of claims come over. The insurance, small insurance cannot cover. So if they cannot cover, what they do? They have gone bankrupt. They have to close down. Then the policyholder cannot get anything, so they cannot be allowed. That's why in the balance sheet, they must, in the account, when they submit to the government, they must show their future risk, how they're going to cover. So either they have to retakaful it to the normal Islamic way, or even the reinsurance it to the conventional, if the Sharia compliant conventional insurance company. So all these things is very interesting for you to know the basic operation of how the insurance operate, and there's some distinct difference between how the conventional insurance operation and also the Islamic way operation, which is conventional is more purely commercialized, whereas the Islamic way is more like cooperative way of helping each other. So that's for today lecture, and you continue discuss further in class, and anything that you understand can let us know lah. So thank you very much. Assalamualaikum warahmatullahi wabarakatuh.